Welcome to tastytrade's option strategy series. In this episode, we will go over the covered call, which is known as an income-producing strategy for a stock or ETF position. What is a covered call? A covered call can generate income by selling a call option against 100 shares of stock or ETF. The call option is typically sold above the current market price of the stock or out of the money. This is done to increase the trade's profit potential and reduce the risk of assignment. However, this doesn't guarantee your short options will remain unassigned. If a short call faces early assignment or expires in the money at expiration, each assigned option has an obligation to sell 100 shares at the short call's option strike price. This is where the covered call gets its name. The long shares offset the short call assignment. As such, covered calls generally carry less risk than other option strategies since the long shares collateralize the short call. Now that we understand the basics of a covered call, let's dive into how this type of a strategy becomes profitable. Assuming the call option sold against the stock remains out of the money or above the stock price for the lifetime of the call option, the value of the call option sold may erode each day due to time decay and potentially yield a profit if the position is closed before the option's expiration. The other alternative is to hold the out-of-the-money short call into expiration date of the contract. A short call that is not closed and expires out of the money will be worthless, and the investor would keep the entire credit received from selling the call against their shares. With this in mind, let's take a look at a trade example. Suppose an investor owns 100 shares of XYZ stock priced at $100 a share. After analyzing the stock's price movement, the investor expects little growth in the stock's price in the upcoming months and wants to generate some income in the meantime. The investor decides to sell 110 strike call option against their XYZ stock position and collects a $700 in premium. By selling the 110 strike call, the investor's profit potential on the shares caps when XYZ's price increases to $110 or higher. Now, depending on the stock's performance, one of two outcomes may occur. If the stock price remains below $110 at expiration and is trading at $90, for example, the option will expire worthless, out of the money, and will likely not get assigned. Due to the downward movement in XYZ, the stock position will suffer losses. However, the $700 in premium received from selling the call can help offset those losses. On the other hand, if the stock price rises beyond the $110 strike to a price of $120 at expiration, the in-the-money option will likely be assigned and the 100 long shares will be sold at $110 per share. In this scenario, the investor profits $1,000 from the stock price movement to $110, but also benefits from the $700 in premium collected, resulting in a total profit of $1,700. Although selling covered calls may generate income, there are some risks to consider. There's always the risk that the stock price falls, which could help yield a profit on the covered call alone, but the profit made on the covered call may not cover the value of the lost shares. On the flip side, there's also the risk that the stock continues to rise far above your short call strike, resulting in limited profitability in exchange for the premium collected. Finally, if an investor sells a covered call at a strike price below the share's cost basis, it could result in locked-in losses if the shares get called away or sold. In any case, the covered call strategy can be a strong tool in your trading arsenal to potentially generate income on long shares. Looking to place a covered call on the desktop platform? Check out our tutorial videos here.